Hello everyone, thanks for checking out my video. The Santa Claus rally skipped Wall Street for second year in a row as S&P 500 went on a 5-day losing streak that started from Boxing Day. But fortunately, the market rebounded strongly last Friday to clock its first gain since Christmas. Megacap tech stocks were the highlight for the market last Friday, with Tesla popping more than 8%, Nvidia climbing more than 4%, Amazon, Alphabet and Meta rising more than 1%. As we enter 2025 and put aside the Santa rally's absence, investors could be looking at another indicator which has correctly forecasted full-year stock performance with a 70% to 80% accuracy since 1950. That's a good 55 years ago. So if you wish to find out more, do watch till the end of this video, alright? Last Friday, the US stock market shook off a shaky and sluggish start to 2025 as major indexes surged. This has helped to snap a 5 straight days of decline, the longest losing streak since April 2024. And no surprise, the latest comeback was led by a rally in shares of major technology companies. But despite the end-of-week rally, the three major indexes finished with losses for the week. The overall weakness in the last 2 weeks also means that the Santa Claus rally, in which stocks typically gain in the final 5 trading days of 1 year and the first 2 trading days of next year, has failed to materialize. All that being said, after the late-in-the-year weakness and the very oversold market, it's always nice to finally see some buyers stepping in. More importantly, the major indexes are still not too far away from their record highs. As fund managers from major financial institutions come back to work and with trading volume picking up this week, let's see if this bullish recovery trend can continue. Okay, the first major test of 2025 in the upcoming week is December's jobs report. The report is scheduled for release on 10 January, Friday. The market expectation is a growth of 150,000 jobs with the unemployment rate at 4.2%. In case you are not aware, the labour market data has become one of the most important data for the Fed and investors in recent months with regard to the strength of US economy. Both parties would like to see a jobs report that shows a stable but not overheated economy. Basically, any kind of data that suggests the labour market is weakening more than expected could be a signal that the US economy is weakening as well. This could trigger and create more volatility on top of the recent market volatility. Interestingly, investors are also a bit cautious of a jobs report that signals an overly strong economy because that could potentially revive inflation. While this may seem contradictory, it's about finding a balance or equilibrium in this complex economic environment. Anyway, the latest data may aid the Federal Reserve in shaping its interest rate decision for 2025 after the central bank rattled the stock market last month by reducing its projected rate cuts for this year. Speaking of the Fed, on 8 January Wednesday, the market will receive the minutes of last month's FOMC meeting. Some investors may scrutinize the details and rate cut projection, but I don't think it will cause another tsunami in the stock market since the Fed has already shaken the market last month. Meanwhile, in about 2 weeks' time, on 20th January to be exact, US President-elect Donald Trump is expected to take the oath of the office. In case you're not aware, while Trump's proposals, which include cutting corporate taxes, easing regulations and imposing tariffs, could boost corporate profits and the US economy, but they also run the risk of causing inflation to tick up again. With a new wave of quarterly corporate earnings commencing this month, this January is definitely going to be a jam-packed month. Moving over to technical analysis. How should I begin this? First of all, I have to say that this month is going to be quite tricky for traders or even long-term investors to navigate due to a potentially higher than usual volatility. Other than this being an action-packed month, as I have mentioned earlier, the chart is also showing me that this could be a decisive month that set the tone for the stock market, at least for the first quarter this year. Okay, basically one pattern and 2 levels to keep an eye on for SPY. The one pattern is this bearish head and shoulder pattern. If this materializes, the move down can be huge. When I say huge, I am talking about 560 range, which I had shared in my last video. So how do we know if this bearish pattern is playing out? Well, for confirmation, watch out for the neckline at around 581. Coincidentally, that's where the critical 61.8 Fibonacci retracement level is, which makes it even more important. If this level breaks, I would expect the gap between 574 to 580 to be filled. And when the overall sentiment changes, when market makers dump their shares, we could say hello to 560's range. On the other hand, if the bulls can protect this 581 level, then all is good. But that doesn't mean SPY is very bullish. It just means neutral to slightly bullish, as the market could go sideways. For me to call SPY or the broader market to be bullish, we would need to see SPY breaking above 603 at least, because that's roughly where the highest point of the shoulder pattern is. By going above this level, it kind of invalidates the head and shoulder pattern. But for a full bullish breakout, SPY needs to create another record high, which means to go above 607. I know it sounds like I am stating the obvious, but based on the current chart and setup, that's really how I see it. So to summarize, the one pattern to watch is this head and shoulder pattern, and whether this pattern plays out, it depends on two key levels, 581 and 603. Jumping over to Apple's chart, if you could recall, I mentioned in my last video to watch the MACD and RSI closely. When the MACD crosses down, then Apple is bearish. This is because the RSI can drop further, which means more room for Apple to pull back. I also specifically mentioned that I will not be adding to my existing Apple position because Apple has been on a parabolic run, and if it wants to fall, there's so much room to fall. Guess what? All of this that I have shared happened as Apple was one of the weakest Mag 7 stocks last week. It fell from 255.59 to 243.36, which is equivalent to 4.78% drop. In case you go thinking what is a less than 5% decline, because shares like Tesla, Palantir can easily move 5 to 10% in a day. Well, in case you're not aware, it doesn't work that way. For Apple's market cap, a 1 to 2% drop in its share price is quite significant. To put things in perspective, a 4.78% drop in Apple's share price is worth about $185 billion of market cap. The same percentage drop for Tesla based on its current price is about $63 billion, and in Palantir's context is less than $9 billion. Anyway, I hope my analysis could help to earn a like button from you. If not, spare me a minute or two. Let me do a quick introduction of this new brokerage account that I have recently signed up. It's called Longbridge. It basically is a low-cost brokerage where you can invest in stocks, options, ETFs, REITs, etc. on the platform, and they cover Singapore, Hong Kong and the US markets. Longbridge is relatively new, started in 2019, but they are backed by leading global tech companies such as Alibaba and ByteDance, aka the parent company of TikTok. Okay, more importantly, the company behind this brokerage is a licensed entity regulated by the MAS. You can check out their licensing status on the official MAS website. And oh, just to add on, Longbridge has appointed DBS Bank, which is the Singapore's largest bank, as its custodian bank for its clients' monies here in Singapore. Okay, but all this being said, I would suggest that you do your own research before considering signing up with them. And if you would like to sign up for an account, you may consider using my referral link, which I have included in the description and comment section below. It's valid for customers who is living in Southeast Asia. They currently have some welcome rewards for the month of January. The most straightforward one will be to deposit 2,000 Singapore dollars and you will receive an 18 Singapore dollars cash coupon, which will be credited as cash into your account after you activate the coupon. This $18 is exclusive to Longbridge partners like myself and some other content creators. On top of that, they are also giving out this 8% per annum interest boost coupon, which you can use to subscribe to Money Market Fund, where you will get an 8% boost to your interest for the first 2,000 Singapore dollars. For other tiers of rewards, you can check out their website for more information. Okay, sorry, back to business. At this point, there are two key levers that will help us to ascertain whether Apple can stop its short-term rot or not. The first level is the 50% Fibonacci retracement level at 240. If you are new to this channel and in case you don't know, this particular Fibonacci level is a common level for a stock to rebound or get rejected, depending on whether it's on an up or downtrend. Therefore, in this case, for Apple to retain or resume its uptrend, it has to bounce off from this level 240. If it doesn't bounce at 240, that's alarm bell number 1. The second and final alarm bell is actually an area, not so much of a level. This area is between 235 and 237. This range consists of 3 key levels. First is the 50 moving average at 237. Second is the critical 61.8 Fibonacci retracement level at 235. And thirdly, if I were to zoom out the chart, you will be able to see this blue line that I drew, which was a level of resistance in the past. It has now turned into a support level, and this level is around 237. As for the upside, straightforward, reclaim 250. What that means is, it's not just about touching 250, it needs to close above 250 for at least 2 days. From there, then naturally, it gives us more probability to create another all-time high. To be honest with you, given Apple's unimpressive growth and sales in China right now, I half suspect it's Apple's share buyback plan that is pushing the share price higher in the last 1 month. I don't know about you, but I am definitely not adding Apple shares at the current level. Let's now hop over to Tesla, the most interesting stock right now, at least in my opinion. So, last week was an eventful week for Tesla. On 2nd January, Tesla reported a miss in both their 4th quarter and 2024 overall delivery numbers. I saw 2 estimated quarter 4 numbers on the internet, 506,000 and 512,000. But the figure came in at less than 500,000 at around 496,000. The full year estimate for 2024 was 1.8 million cars, but the actual number was 1.79 million. This is Tesla's first annual decline in their EV deliveries. Therefore, there was no surprise that the share price gapped down and plunged 6% on that day. But then, surprise surprise, Tesla bounced back up the very next day as the share price popped more than 8%, recovering all of its previous day's losses. That was the day I stepped in to execute a slightly bullish option trade. More on that later. Anyway, what to watch this week? Naturally, many Tesla investors and traders would want to know if last Friday's bounce could continue, or was it a dead cat bounce which will lead to a further decline. Okay, let's cover the bullish thesis first. Tesla needs to hold and continue to stay above this 383 level where the 38.2 Fibonacci level is. But by doing so, Tesla is not out of the woods yet. It has to reclaim the 23.6 Fibonacci level at 423 to resume its bullish momentum. If we can do that, it simply means buy the dip crowd don't quite care about Tesla's delivery numbers for now, and I would think more FOMO investors will step in above 423, thus driving the share price to 480's range again. On the other hand, remember I previously shared that once 400 breaks, don't blink your eyes because we could see 380s very quickly. Well, that just happened last week. But that being said, I want to be honest with you, when Tesla closed below 380 on 2nd January, I thought market makers and paper hand retail investors could bring the share price further down to 350's range. But I was wrong. That's why I said it came as a surprise that Tesla bounced up within a day. Anyway, in terms of the bearish thesis, watch for the 383 level where the 38.2 Fibonacci level sits. If we close below it again, I still believe there is a probability we will see 350's range. But of course, we will need better confirmation. Last week shows that 1 day below 380 is nothing. So if Tesla closes below 380 for 2 to 3 days, then 350s could be in sight before you knew it. Next up, let's have a look at Google's chart. Honestly, I don't have much to update for Google this week, so this will be a quick one. Reason being, Google traded sideways last week, and this bearish mini head and shoulder pattern that I have identified is still intact. Basically, Google did nothing to confirm nor invalidate it. Therefore, just like last week, continue to watch this 195 to 196 resistance area. A solid close above 196 would more or less invalidate the bearish head and shoulder pattern. But for confirmation, I know I might be stating the obvious, but yeah, it's to hit 200 and probably to create another all-time high. By doing so, it will definitely invalidate the bearish pattern. As for the bearish thesis, 185 to 186 area would continue to be a key level or area to watch because that's where the neckline of the mini head and shoulder pattern is. If this area breaks, I would expect to see Google at sub 180s again and possibly feel part of that huge gap between 176 to 181. Okay, if you look carefully within the gap, we have two strong support levels. The first one is the critical 61.8 Fibonacci level at 178, while the second support is at 176, which is the 50 moving average. This 176 to 178 area could be an area for me to consider stepping in to either pick up shares or sell puts. Oh yes, just one more thing to add. If Google continues to trade sideways this and next week, that will somewhat invalidate the head and shoulder pattern as well. Alright, moving over to Meta's chart. Okay, so in my last video, I shared about this bearish inverse cup and handle pattern. Just like Google, last week's movement was non-conclusive. In other words, there is no confirmation whether the pattern is going to play out or not. But again, similar to Google, if Meta continues to go sideways this week, then the cup and handle pattern could be invalidated. Or if Meta climbs above and closes above 605, that will help to invalidate this bearish pattern as well. Anyway, between 605 and the all-time high of 638, it's actually a mini consolidation zone. I wouldn't be surprised if Meta chop around this range until its earnings, which is less than a month away. On the other hand, if Meta decides not to chop around, then watch for 580 to 586 area. This is where the neckline, the 50 moving average and the 38.2 Fibonacci level are. If the bears somehow manage to bring Meta below this area, I would think 567 is the next target. 567 is where the next meaningful support level is, because it is formed by the 50% Fibonacci level as well as the 100 moving average. Alright, next up, Microsoft. As previously shared, it seems like we have a potential bearish inverse cup and handle pattern on the chart too. But I must say the pattern is not quite there yet. It seems like the cup is just forming. We are lacking the handle. Okay, anyway, that pattern aside, Microsoft was pretty bearish before last Friday as it fell for 5 consecutive days. During this period, it has reached an area of strong support formed by the 200 moving average, the critical 61.8 Fibonacci level, 100 moving average, and that green uptrend line. Wow, 4 support levels coming in together. This shows how strong this area is, which is between 421 to 424. At one point, I was observing whether Microsoft is going to bounce off the strong support zone. Well, it actually fell below it briefly, but then last Friday it bounced up, which got me thinking, will it be a case where market makers try to create a false breakdown and then they bring the share price up again? Anyway, I don't know, I really don't know, so watch for this 421 to 424 area again this week. How Microsoft reacts to this area will give us some indications. If this area gets breached convincingly by the bears, then one can expect more weakness in the share price. That's when I could step in to buy its shares. In fact, I stepped in last week for an option trade. More on that later. On the other hand, if Microsoft goes back above 424, that's a good news for the bulls. But for the bulls to celebrate a little bit more, they would want to see Microsoft reclaiming the 50 moving average as well at 428. I mean, if Microsoft can reclaim all 3 important moving averages, the critical 61.8 Fibonacci level, and also keeping the green uptrend line intact, and that is not bullish, then I don't know what is. Last but not the least, Nvidia. We have a breakout. I repeat, we have a breakout in Nvidia. As you can see on the screen, Nvidia has been stuck in this red downtrend channel since November last year. Prior to last Friday, Nvidia has been knocking on the door by testing the upper end of the channel for 6 consecutive days. And finally, we had a huge green candle last Friday, which represents a solid breakout. especially when it also reclaimed the critical 61.8 Fibonacci level. Okay, let's cover the bullish thesis first. We could have two potential bullish scenarios from here. First scenario, Nvidia never wants to look back in the next 1 to 2 weeks as it continues to go higher towards 150's range to create a new record high. For this to happen, watch the level 143 where the 61.8 Fibonacci level. This is a very important support level to defend and to stay above in order for the first bullish scenario to happen. Second bullish scenario, Nvidia retraces, fill that tiny gap, retest the downtrend channel and rebound up. That's what I call a classic retrace, retest and rebound. But again, we will have to look at the 143 level eventually. If Nvidia bounces off the channel or the other support level at 140, it still has to go above 143 for a full-blown bullish breakout. Okay, for the bearish thesis, straightforward. If Nvidia falls back into the downtrend channel, then that's a bit bearish. For us to say Nvidia is pretty bearish, it's when 127 breaks. When that happens, we could be headed towards the bottom of the channel. That's around 117 to 118. If this ever materializes this month, it is definitely a place that I would want to step in. Let's now check out my options trades. Two new trades to update this week. The first one is this cash secure put on Tesla that was sold last Friday, 3rd January. The strike price is $2.95 and the contract will expire on 31st January this month. Let me share with you my thought process behind this trade. What happened was, as shared earlier, 1 day prior to the day that I sold the contract, Tesla reported its 4th quarter as well as 2024's full year delivery numbers. It came in below estimation and the share price tanked 6% on that day. With that, it also means that Tesla has fallen for 5 consecutive trading days, dropping from a closing price of $462 to $379, which is about 18% plunge. As a result, the RSI was reaching oversold levels soon. This means that Tesla could have a short-term bounce anytime. But little did I expect the bounce came so quickly on 3rd January Friday. So when I saw that, I quickly stepped in to sell a put contract, which is a slightly bullish move in attempt to ride the short-term bounce up or sideways movement. I must say that particular day's movement was rather crazy as the buy the dip crowd stepped in to push the share price up by 8%, recovering all the losses it incurred in the post-delivery numbers drop. But given how volatile Tesla's share price is, we never know if this is just a dead cat bounce, which means the share price goes up to cool off the oversold indicators and then we see another round of dump by the big institutions. Therefore, to mitigate my risk, I chose a strike price that is pretty far away from the current price. In exchange, I will have to sacrifice some premium, which I am okay. Anyway, for my strike price to be breached, Tesla will have to fall from the current price of $410 to $295, which translates to a 28% drop. Don't forget, Tesla has already fallen quite a fair bit prior to this. To put things in perspective, to drop from Christmas Eve closing price of $462 to my $295 strike price, that's a 36% crash. Possible? Yes, possible. But to happen by the end of this month, the odds are not that high, at least in my opinion. The only risk I could face right now is its earnings around 3rd week of January. Let's see how this trade pans out. The second trade to update this week is this cash secure put on Microsoft, which was sold on the same day, 3rd January. The strike price is $385 and the contract will expire on 7th February. The thought process behind this trade was rather simple. As shared in my last video and in the earlier technical analysis segment, Microsoft has reached an area of strong support where it could potentially bounce up. On top of that, the RSI was at the oversold level, which further increases the chance of a short-term bounce. And so the bounce came last Friday. Just like Tesla's trade, I saw that bounce, I stepped in. But also, just like Tesla's trade, there could be a chance of a dead cat bounce, which means the market makers could dump the shares shortly after the bounce. Once again, to give myself some margin of safety, I chose a lower strike price at $385. Why 385, you might ask? Well, 385 is where the 138.2 Fibonacci support level is, and it is also below that green support line that I drew. With a few other support levels above 385, I would think this strike price does offer me some buffer in case the market makers decide to dump Microsoft shares in the next 2 weeks. Another thing to note, the last time Microsoft closed below 385 was in January 2024. So if Microsoft ever falls back to this level this year, it's really a great discount, at least in my opinion, and I don't mind getting a side with 100 shares of it. Okay, 2025 is here. With a no-show from the Santa Claus at Wall Street, investors will have to put that aside and start looking forward. Some may have already shifted their focus towards the next indicator that could potentially give us some clues on where the market is headed to this year. That indicator is called the January Barometer. The concept was first introduced in 1972. The gist of the barometer is simple. According to historical data, if stocks see positive gains in January, the year often ends positively as well, and vice versa. Specifically, this pattern has shown about 70 to 80% accuracy over many decades, and this has created a saying that goes like this: as January goes, so goes the year. Well, statistically speaking, it works most of the time, but just like any market indicator, it is not foolproof. The January barometer has its own critics. For example, this concept only looks at S&P 500 index, and in recent years, the concept has seen mixed results. To add on, some research has shown that this idea is more accurate when January is a positive month. But then, if you realize, this is clouded by the fact that the stock market's yearly returns have been positive, I think about 2/3 of the time. In short, the S&P 500 generally goes up in the long run and in most of the years. Okay, then you might think, why would I bother bringing up this concept in the first place? Well, first of all, I found it interesting and I thought to share it with fellow viewers who don't know about this fun fact. Also, I think if January turns out to be a positive month, it is always good to know that the overall odds is in our favor to see a positive year, at least for me. I mean, I believe in seasonality and trends, but I'm not overly obsessed because there is no crystal ball to stock market forecasting. Okay, but even if you are like me, believe in this trend and statistics, please do not go all in when you see a positive January. Point here is, regardless of January's historical strong returns and supposed quote-unquote predictive power, we as investors should always make investment decisions based on fundamentals of the companies and the overall economy. This means even if you don't stock pick and you only invest in the indexes, it's still good to pay attention to the macro environment before you decide to go aggressive or not this year. But if you are an investor who DCA into the market, then I guess all those that I have shared don't quite resonate with you, so just take it as fun fact. Okay, putting aside this whole January barometer, some quick thoughts from me. The beginning of the year is often filled with anticipation and optimism. You know, just like how we always set New Year resolution. But a lot of times, by the end of the year, we usually find the reality being different from our expectations, whether to a small or large extent. So, as in life, investors should not lose sight of the long term in the stock market, regardless of what January brings. As with any other year, this year presents uncertainties as well, such as Trump Administration 2.0 and its related economic policies, inflation trend, labor market trend, Fed's interest rate campaign, etc. I have shared all this in my last video, so I won't elaborate further here. And given the extent of the huge gains in the last 2 years, it is only rational that some investors would be expecting a significant pullback from this point. However, don't forget, you can think rationally, but the market might not be rational. Whichever form of pullbacks we have this year, I would view it as buying opportunity, not a reason to panic, because such pullbacks are usually irrelevant in the grand scheme of things. But of course, this is my view and not a financial advice to you. Personally, I think the technicals are still bullish and the fundamentals of good companies remain strong. I will keep you guys updated through my weekly videos if any of this changes. Meanwhile, if you found my content useful, do support this channel by tapping the like button and commenting something below. Thank you very much.